So once again, I want to welcome you to the Dazzling Market Watch. My name is A.A. James, the CEO and the founder of Dazzling FX. All right. So let's head over to the chart and let's see what's going on there. Now, how does the market move? Simple. Let's just remind ourselves. This has nothing to do with strategy right now. Absolutely nothing to do with strategy. All right. Market moves in three directions. The first direction, you see the market is moving up. Second direction, market is moving down. Or third direction, market is just moving sideways. All right. These are the three major ways the market moves. And when the market is moving up, you want to buy. When the market is moving down, you want to sell. When the market is moving here, you want to avoid the market. There are some people that have strategies whereby they buy at the top, all right? They sell at the top and they buy below, all right? But I don't do that. No, I don't do that. Okay, so I don't even teach people to do that, all right? So I just focus on these two direction. Market moves up, market moves down. When market is moving up, you look for buy setups alone. You look for only buy setups. That's the only thing. And when market is coming down, you look for only sell setups. Simple. Where do you buy from? You buy from the higher lows. And what do you sell from? You sell from the lower highs. All right. So in a market that is going up, this is how it's going to look like. This is it. All right. So you buy at what? The higher lows. That's simple. You buy at the higher lows. Very simple. For a market that is coming down, all right, you sell at the lower highs. Market is so simple that we don't need to complicate anything. You do not need to complicate anything at all. At all. All right. So here is it. You buy at higher lows and you sell at lower highs. So let me just write it here. You have your higher lows. Okay. Let's make this like 28 so that we can see it properly. Nice. So these are higher lows. All right. These are higher lows. Okay. And these are lower highs. Okay. Nice. So these are lower highs. If you can master this, you can master trading. There is nothing else you are going to look for that will not work out for you. Okay, regardless of your strategy. This has nothing to do with strategy. Absolutely nothing. Okay, nothing to do with your strategy. So this is the direction of the movement. I'm not interested in what do you call it, in range or in whatever. I'm not interested in that. Okay, so now for today, I'm going to be looking at a particular tool that someone asked me before, and that particular tool is the Fibonacci tool. All right. So because now I understand that there is a major question here, and this is if this market broke the low and is on its way up. Okay, market just broke the structure here. Excuse me, market broke the structure here. All right, this is a break of structure, right? So now, two things. How will I know where the market will stop? Okay, let's say peradventure market came to, let's say, this area, and you bought and you sold in this area. Question, where is going to be my take profit? So you use your Fibonacci for two major things, and that's what I'm going to be teaching us this evening. All right, remember there are a few things we're doing. The first one is training. The second one is we'll analyze the market. Okay, the third one, we'll look at the news that is happening this week, and the last one is we'll look at potential setups and the question and answers. All right, so briefly, this is Fibonacci. Let me change to default. This is how the default Fibonacci looks like. If you want to use Fibonacci, In a downtrend, you draw it from up to down. So the up is 1, the down is 0. In an uptrend, you draw it from down to up. So the down is 1, the up is 0. For example, this guy is obviously coming down. All right. If this guy is coming down, we don't know where this guy would stop or whatever. Let me even leave it like this. Okay. So I'm going to take the Fibonacci and take from the swing high, from the lower high to the lower low. That is what I'm going to do. You draw your Fibonacci from the lower high to a lower low in a downtrend, and from the higher lows to a higher high in an uptrend. Okay, good. So when that is done, you see that there are different levels here. You have 0.23, you have 0.38, you have 0.5, 0.61, 0.78, and you have 1. These are the default levels. You can modify your own. I can modify my own. All right. For example, I already have different Fibonacci's here. Okay. Look at 50%. Look at this. I just divided it into 2. Okay, let me make it more clear. See, I just divided it into 2. All right. Look at ABCD. Look at this. Okay. Then look at premium. So different things, even for harmonics. You see, that's for a black chart. Harmonics 2 is for a white chart. All right. But this is the default settings. So now what are these levels? These levels here between the A and the B. This is your A level. All right. This is the A level. Okay. And this is the B level. What is A and what is B? A is simply your lower high. B is your lower low in a downtrend. Do we understand? Let me take this out. Okay. So when you take the Fibonacci from the A to the B, now there are some school of thought that says that you should use a Fibonacci from the body of the candle to another body of the candle. It depends on you, but I use from week to week because the week also signifies that price got to that particular point. So why would you ignore the week? You will see some weeks will be up to 250 pips and you just ignore them. All right. So from week to week, then the first purpose of a Fibonacci is to know where the retracement or the correction will stop. So will it stop at 0.23? That's 23%. Will it stop at 38.2%? Will it stop at 50%? Percentage of what exactly? Of this move, this A to B move. The impulsive move that broke the structure is what you want to know. This correction happening, where will it stop? Will it stop in the 23.6% of the move? Will it stop at 38.2%? Will it stop at 50%? That's half of the move. Will it stop at 61.8%? Will it stop at 17.6%? Or will it go up to the 100% and give you a double top before dropping back down? All right. All these things, we do not know where price will stop. So Fibonacci does not give us an entry signal. No. Fibonacci only tells us that if price has gotten into a particular area, look at the area. There may be a kind of setup when you drill down to the lower time frame. I hope that makes sense. All right. So now, amongst all these levels, price can respect all of them. Yes. Price can decide to take off from this place like this. Price will decide to take off. Sorry. Price can take off from here and continue this way. Price can decide to take off from here. All right. Price can take off from any of the levels. Okay. Now remember that in market, you don't have perfect levels. What you have is zones and areas. Okay, so now, but there are major areas or important areas that by experience, traders, fathers of traders or trading gurus have highlighted to be important zones. Okay, so if you are just trading break of structure and retracement alone, there are areas that you should look at, and those areas are anywhere from half of the entire move, which is 50%, to somewhere around 61.8. Now, the 61.8 is known as the golden number, golden ratio. All right, we will not be going into that today. Maybe in a particular training, maybe subsequent trainings, we would look into that in depth. All right, so now 50%, there's a rule of thumb that says if a market gives you an impulsive move, market will give you back minimum 50% as a retracement before it continues. If a market, sorry about that, if a market breaks out of a range, out of a consolidation, or broke a particular structure with an impulsive move, market will retrace minimum 50% before it continues. So let's say this is the 50% of this A to B move. Now, where is the golden ratio? Because market does not just respect prices. Market respects price areas and zones. So we are looking for a zone in the Fibonacci. The golden ratio is the 61.8%. Everything in life respect the 61.8%. I mean it, including your body molecular structure, the trees, the plants, everything respect the Fibonacci ratio, all right, the golden ratio. So 61.8, look at it here. This is the 61.8. So now let's take the Fibonacci out. So you see, and we can put a rectangle there. This is it. So now, what does this tell us? It tells us that by the time price is coming here, I'm not moved, I'm not bothered. Even if price decides to turn back from here, I'm not bothered, all right? But if price gets into this place, voila, I will go to a lower time frame and look for my confirmations on lower time frame. That's your confirmations. It could be Ichimoku, it could be moving average cross, it could be the railroad, it could be alligator, it could be anything, all right? It could be what do you call this guy? Bollinger Bands, okay? And it could be just simple price action. It could be that you are looking for double top or double bottom. It could be that you're looking for divergence. Anything, it should be sought out in this box. What if it goes above? It is still valid, right? In fact, it's more valid, because if this is 1 naira, sorry, if this is $1, because I know people who are not even in Nigeria will be watching this. If this is $1 and this is $10, so this is $5. So would you prefer to sell at $5, or you would prefer to sell at $7? Obviously, you would want to sell at $7. Okay, so the higher it goes, the more opportunity you have, the more room you have to make all this money here. All this money here, all right? So the first purpose of a Fibonacci tool is to determine or to ascertain the retracement level. You don't know. Fibonacci will not tell you where the retracement will stop. But when it gets into a Fibonacci zone, you will now drill down to the lower time frame to look for your own confirmation. If you find a confirmation here, you will ignore it, all right? It's best ignored, because this is a trap. This could be a trap. If it's happening here, I am going to ignore it. But if anything happens from this zone and above, I will not ignore it. Even if I find 3 or 4 confirmations here, I will not ignore it. Why? Because if I get in here, my stop loss is above the highs. Now look at all the room for me to make money. Okay, all the room for me to make money at this point. You see it? So, but if I enter here, I still have what? All these places are stop loss. Okay, so I prefer to get in at somewhere here. All right, so this is Fibonacci telling you the retracement zone. But now there's another question. There is another question. All right, and that is, when market starts coming down, how do I know where the market is going to stop? Because by the time market gets to somewhere here, market will still do what? Will still pull back again. Since market has broken this B structure, market will pull back again. And we'll still use our Fibonacci and continue like that. So how would I know where market is going to stop? All right, that's where Fibonacci comes in. And that is the Fibonacci extension. All right, so now pick up the Fibonacci tool again. Extend it from this same point, A to B. Go to the settings. Did you see it? Now look at the first extension is 1 point. Let me uncheck this, guys. Okay, now, so you have extensions. All right. There are extensions of 1 point, 1 point, 1 point. But the extension you want to use is this, minus 0.272. All right. Look at it here. We have 1.272 here. Okay, I will tell you what this is for. This is meant for harmonics. You don't need it here. All right, these are meant for harmonics. Okay, so look at it. If I check this guy, you see it's above. If I check this guy, it's also above. Okay, but look at this, minus 0.272. Why? Because your B, which is the beginning of the correction, the beginning of the retracement is 0. Look at it. Do you see it? The beginning of the correction, the beginning of the correction is 0. All right. Now, if the beginning of the correction is 0, do you see it? That means anything below this is going to be minus. So look at this, minus 0.272. Look at it. Then the next one is going to be what? Minus 0. Golden ratio 618. All right. So these are the two. What is it? Good. So these are the two places. All right. So now look at it. When market is coming down, take profit 1 is always the beginning. Always the beginning of the retracement. Don't ever forget. Because market can do something like this and go back up, giving you a what? A double bottom. You don't want that to happen. So take profit 1. When market gets into this area, your first take profit, guys, please take profit. All right. You can't get broke by taking profit, no matter how small the profit is. Take profit 1 is at where? The beginning of the correction. That's take profit 1. Take profit 2. Take profit 2 is now where? Minus 0.272. This is the Fibonacci extension. Most likely, price would get there. Most likely. That's your take profit 2. All right. Most likely, price will get there. Then, if the price, the market is very strong and is trending, you will likely have take profit 3, and that is always at what? 0.618. Take profit 3. All right. So this is now Fibonacci as extension. As extension. So for example, if you have $100 to put on a particular trade, you can risk $40 on this trade because this one is like, let's say 80 to 70% guarantee that market is going to get back to the initial structure. Even if it's going to form a double bottom, market should ideally get back to the initial structure. Okay. Now, $40 should be on your first trade. Second trade should be $30 or another $40 or $35. Then the third one should be $25. So if you're risking $1,000 per trade, you have the same entry, the same stop loss. You have $400 on the first trade, $350 on the second trade, and $250 on this. So you have 40, 35, and 25. So by the time this trade hits take profit, all right, you bring your stop loss to break even. You bring your stop loss to break even for all the trades. This guy has taken profit. Mr. Jolly, this particular profit has now entered into your account just the way I showed you that day, but that day it's only one entry. But here now, instead of closing part, you just decide to divide it into 3. So that even if you are not on your system, automatically it will close by itself and it will close part of it. So instead of having one entry of $100 on a particular trade and closing it out 3 times, just divide it into 3 and have 3 entries at the same point. 3 positions, sorry, at the same point. The first one at the beginning of the correction, at the break of structure. The second one at the extension of minus 0.272. And the third one at minus 0.618. And it is possible that when you check left, there will be other structures, right? But this is using Fibonacci to determine your retracement level for entry and, retracement level for confirmation entry, then for extension to determine your take profit level. All right, guys, so these are the 2 purposes of the Fibonacci. Okay, so now quickly, let me show you something that Fibonacci can really do. All right, so let me show you something, what we call a Fibonacci confluence. A Fibonacci confluence. Let me just do this. Let me take everything out. If you have market doing this, all right, market is going down. Now you already have a break of structure here. This is a break of structure. Okay, so where is the market going to stop? You will not know. All right, so we take our Fibonacci tool from point A to point B. Okay, let me quickly label that. This is point A, right? And this is point B. Okay, this is point B. All right, so, and you know, we do week to week. Okay, so let's see. Let me bring this guy here. Good. Just a minute, guys. Good. Perfect. So now, the first place for you to check is your what? The golden zone. And the golden zone is half of that move. And half of the move is 50%. See the 50% here. Okay. Half of the move is 50%. See it? 50%. And golden ratio. So this is the golden zone. The golden zone is half of the Fibonacci of the impulsive move and the golden zone. So this is half. Look at it. This is it here. All right. So check the Fibonacci out. Ladies and gentlemen, you have a very high probability trade if your Fibonacci zone is the same area as your previous structure here. This is a high probability zone. This is what we call in demand and supply, we call it a flip zone or a support becoming resistance. All right. So it is important that when you are looking for Fibonacci areas, the trade setups that have Fibonacci areas in confluence with previous structure, they have high probability. Okay, so if you have a confirmation in this place, let's say you have a divergence or something in this place, nice, then you cannot get into the trade here. All right, you can get into the trade instead of putting your stop loss here. Because of this particular setup, you have your stop loss here, and take profit one is always at the beginning. All right, so you have this as take profit one. All right, take profit two, take your Fibonacci again and do this. So you have take profit two as what? As this guy. All right, take profit two. Okay, then you have take profit three here. Okay, so this is take profit two. Let's even leave it at take profit two. All right, so this is how this trade setup is going to look like. All right, guys, so you see now how we've used Fibonacci to determine our area of interest, and it's in confluence with a previous support or a previous structure. The same thing is going to happen, all right, for a buy move. It was a previous resistance now becoming a support. The same thing we're looking at. Okay, so we have also used the Fibonacci to know our take profit area, which is the extension minus 0.272. This brings us to the end of the Fibonacci class today. Thank you, guys.